स्लाइड चेंज कैसे? अच्छा,
इधर से एक्सेस करोगे तो एक सेकंड।
ठीक है. Hello all, welcome to today's session on tax planning and investment. My name is C.A. Shokotra, and today we are joined by C.S. Rahul Seoda. Now Rahul is a part of Clear for last 4.5 years. He, alongside me, handles the internal tax team of Clear Tax. Now during this webinar you may have some question regarding everything, so in that regard you can drop the questions on the chat box and Rahul is here to answer all those questions. Now let's take a look at today's key takeaways. So during this session we are going to talk about who should be planning for their investment, why one should be making this investment, and what are the things that one should be keeping in mind during the year. And we are also going to take a look about the new tax regime as well as the old tax regime, the tax benefit that are available under both of them and old. So that is the agenda of today's webinar. Now firstly, who should be planning for their investment and its declaration. Now in the new tax regime, if we are talking about new tax regime, over there is very less requirement for you to declare all the tax saving investment, because under the new tax regime there are very less option for you to declare the investments, right? This is because they have the income tax department have tried to simplify the income tax return filing process. However, people who are opting for old tax regime, the investment declaration and planning for investment still hold a great amount of relevance. However, if that person who is opting for income tax, who is opting for old tax regime and income is no more than 5 lakh rupees, in that case, even though that person is required to file income tax return, no tax will be deducted by virtue of giving him a rebate. Therefore, anyone who is opting for old tax regime and income is lesser than 5 lakh rupees, in that case there is no requirement, or rather there is very less requirement for them to declare the investment. Now all the investment, what are the things that can be declared? So investment like insurance, home loan, rent paid, etc., most definitely they can be declared. However, along with the investment, tax saving investment, another thing you can declare, that is the incomes, right? So during the year, most definitely you will be having salary income. Yes, apart from that there will be some additional other sources income as well. For example, FD interest, for example dividend income, for example savings bank account interest. So all those things add to your taxable income. However, if you are not paying taxes on them, right, then there is a liability for payment of advance taxes. So how it happens is, after computing all the income and taking all the TDS credits, if the tax liability is beyond 10,000 rupees, in that case you are supposed to pay taxes in advance quarterly way, right? But if you are not making those sort of payments, then at the time of filing the income tax return, you could face some amount of interest on default of paying the advance taxes. To avoid this situation, what you can do is you can declare all the other sources of income to your employer, so that while computing their Form 16, they can consider all this income and deduct the taxes accordingly. Now, over here, I completely understand that guessing there will be some amount of assumption applicable involved in this entire scenario. Why? Because at the beginning of the year you cannot say how much you will be getting other sources of income, but if you could make a bulk, you can make a declaration on a higher side, you could face a lesser amount of interest. Now let's try to understand why should one be making the investment. So first and foremost, saving the taxes, right? Now in the advent of new tax regime, tax saving investment is losing its sheen. Why? Because new tax regime has been made default. You have to actively select old tax regime to opt into old tax regime. Furthermore, the new tax regime is becoming much more simpler. So you don't really get any of the deductions, you don't really get any of the headache that relates to those investment. You are not required to keep any receipt or declare. Simply opt into the new tax regime and it will be computed based on the slab. Furthermore, in this budget, the rates has been clearly increased by the income tax department, which is making the new tax regime a little bit more attractive as compared to previous couple of years. Therefore, saving the tax only just to save the taxes, this trope does not really apply on the old tax regime anymore exclusively. But making the investment, going for the investment, that has other implications as well apart from saving the taxes. For example, creation of wealth, creation of assets, saving for the future. So those things coming together hand in hand and giving you the reason to make the investment, right? So you can certainly go ahead with this. Now another offbeat reason for making this type of investment is to reducing unwanted expenditure. So at the beginning of the year, what we see is, because we have received a higher amount of money in our bank account, we tend to go out and spend exuberantly in certain items. But if we create a routine for ourselves that after getting our salary, within couple of days time I will be making XYZ investment. It can be a stock market investment, it can be ELSs, whatever it may be, even it can be gold or SGV, sovereign gold bonds, etc., etc. It will lead to a lesser amount of cash available in your hand, and you could certainly curtail a huge chunk of unwanted expenditure. Now let's take a look at the tax saving expenses. Now there are two ways you can save the taxes. There are two ways you can take the opportunity. Number one, you can take advantages of certain expenses for tax saving purposes, or you can make the investment. Now let's go through them one by one. Let's come to tax saving expenses. Now the biggest tax saving expenses is house rent allowance. Now house rent allowance is given to you if you are staying in a rented apartment for your employment purposes. Furthermore, if your salary have a HRA component, then only you will be able to claim HRA allowance benefit. If your salary does not have it, in that case you should seek out and allocate some money in HRA. However, there are a couple of misconceptions attached to house rent allowance. The biggest one of them is that the amount of rent that I am paying as rent is entirely deductible as house rent allowance, which is not the case. To compute HRA, deductible HRA, there are three figures that we need to look at. Number one, 40% or 50% of the basic salary. Number two is actual amount of HRA that I am receiving. And number three is actual rent that I am paying minus 10% of the basic salary. Now, out of these three figures, whichever is lesser, that will be given to me as HRA allowance and that will be deducted. Now, 40% or 50% of the basic, that could create a confusion, in which case 40% will be considered, or and which case 50% of the basic will be considered. Now, if you are staying in any four of the metropolitan cities, that are Delhi, Mumbai, Kolkata and Chennai, in that case 40% of basic will be the figure. If you are staying for employment purpose in any other city in India, it may be Delhi, it may be Pune, it may be Chandigarh, it may be Ahmedabad, Bangalore, you name it. If it is not four cities, it will be 40% of the basic. Second figure is HRA received, that is pretty much self-explanatory. And the final figure is actual rent paid minus 10% of the basic. Now, let's come to a situation wherein you are getting a salary of 10 lakh rupees, right? Total salary of 10 lakh rupees, out of which 5 lakh rupees is your basic salary. We are talking about the yearly salary. Now, out of 40 lakh, and your HRA component is, let's say, 2 lakh rupees, right? Now, you are paying 2,40,000 rupees a year, that is 20,000 rupees per month as rent. In this case, how the HRA will be calculated? Firstly, we are going to take a look at 40% of the basic, because we are assuming you are staying in a city which is not Delhi, Mumbai, Chennai or Kolkata, right? So 40% of the basic will become 2 lakh rupees. Actual amount of HRA is again 2 lakh rupees, and 10% of actual rent paid minus 10% of the basic will become 2,40,000 rupees minus 50,000 rupees, which will be 1,90,000 rupees. Now, this 1,90,000 rupees will become my HRA deduction, and it will be deducted from my taxable salary. Now, leave travel allowance, another great tool to save some amount of taxes using the travel expenditure. Now, how it happens is, it is allowed to you only twice in a block of 4 years. That means if you are traveling for 2 times in a block of 4 years, you can claim it, right? You can travel in other years as well, but the deduction will be given to you for only 2 years over a period of 2 trips, right? So, how it happens? Firstly, you have to travel a place within India. Secondly, you have to travel either via train or via flight. Secondly, you can take your dependent spouse, you can take away your dependent children, your dependent parents as well, right? So, only to and fro expenses are available. So, train fare to and fro or flight fare to and fro is allowed as deductible. Any other expenses such as meal expenses or cab expenses, hotel staying expenses, those are not available. And finally, it is available only under the old tax regime. It has lost its relevance under the new tax regime. Other expenses that are available for you is petrol expenses and driver expenses for motor car. Now, depending on the engine capacity of the car, the deduction for petrol expenses is 1,800 rupees or 2,200 rupees, and driver expenses in both the cases will become 800 rupees per month. Now, this deduction is available under both the tax regime, new and old. Furthermore, you can opt for food coupon, for which you can get a deduction of 2,200 rupees maximum. The number comes to in this fashion: for 50 meals, 50 rupees per meal, for maximum of 2 meals for 22 working days, right? So, which will give me 2,200 rupees as deduction amount. Again, This food coupon allowance is only available under the old tax regime. Now, other tax saving expenses can involve interest paid on home loan. Right, so interest paid on home loan can be claimed as deduction under section 24B. It is normally treated as loss on house property. Now, in case the loan is taken for a self-occupied house property, maximum of 2 lakh rupees of deduction can be taken. Right, now this interest expenses is granted to you from the year of possession, from the year you start possessing that house. Now there are certain situation in here as well. So during the time the house, sometimes it may so happen you go ahead and purchase a flat which is still under construction, and the construction gets over in another 2 years time. Right, so during the construction period you don't stop paying the interest, you keep paying the interest. So what will happen to that construction period interest? Firstly, once the house is completed, from there onwards, whatever interest you have accumulated for the construction period, you can claim it over a period of 5 years in 5 equal installments. Now, let's try to understand how this plays out. Firstly, let's assume that you have purchased a house in 2020. The house is completed in 2021. Right? So, there are 2 years. In 2 years, the house is completed. So, each year, let's assume you have paid 1 lakh rupees each. Right, so totally 2 lakh rupees. Now in the year 22-23, when the house is completed, let's assume you have paid 1,50,000 rupees as interest. So in that year, 1,50,000 rupees you will be claiming. Along with that, 40,000 rupees, which is 1/5 of 2 lakh rupees of accumulated interest you can claim. So the total amount will be 1,90,000 rupees. Excuse me. However, it should be noted that the maximum amount of loss for house property that can be claimed is 2 lakh rupees. So in this scenario, if I have paid 1,80,000 rupees of interest in the year of completion, in the year of possession, in that case, my total interest claim in the income tax return would have been 2,20,000 rupees. However, out of this 2,20,000 rupees, only 2 lakh rupees will be given to me as deduction. Remaining amount of 20,000 rupees will go to waste. Now, in case you are paying interest on home loan, there is another section you can take the benefit under. That is section 80EA. Now, under section 80EA, another 1.5 lakh rupees of deduction you can claim. However, you have to meet certain stringent conditions. Firstly, the loan should be coming from a banking institute. Secondly, the loan should be sanctioned between 1st of April 2019 till 31st of March 2022. Thirdly, the stamp duty value of the property should not be more than 45 lakh rupees. And the loan should be taken to purchase first property of the person in question. Excuse me. Now, if you are meeting all these conditions, then over and above 2 lakh rupees of deduction under section 24B, you can claim a deduction of 1.5 lakh rupees. Now, the home loan interest deduction under home loan is only available under the old tax regime for self-occupied house property. Now there are couple of common questions that involves home loan. Excuse me, let me just refresh myself. Sorry about that. So in case you have taken a home loan and you are investing into a property, and the property is co-owned. Along with that, the loan is also co-owned. In that case, the interest component and the principal component can be claimed by co-borrowers equally. Right? Mostly we have seen this case in case of spouses. Right? So the flat is purchased in the name of both the spouses. The loan is also taken by both the spouses. In that case, the interest component and the principal component will be shared by both of the spouses. Now another situation arises that uh, can one person claim both HRA and home loan interest? To that, yes, you can claim both HRA and home loan interest. Now, let's assume a situation wherein your hometown is in New Delhi and you are staying in Bangalore for employment purposes. You have purchased a home, you have purchased a flat in New Delhi wherein your parents are staying, and you are staying in Bangalore by taking up a rented apartment. In that case, both the home loan and the HRA can be claimed together. Now let's talk about the tax saving investments. Now tax saving investment are mostly come under 80C and various other section of 80 series, right? So firstly, EPF, PPF and VPF. EPF, every month your employer deducts from your salary, that depends upon the percentage. PPF, again you need to contribute in PPF on your own. Maximum amount can be invested is 1.5 lakh rupees, and VPF, voluntary provident fund, is contributed by you again. Now all these three things can be claimed under 80C. Now tuition fee for children. Now if you have paid tuition fee for admission or the actual education, in that case that amount can be taken as deduction, right? Now the education can be from a school, college or university. Now if you are paying any developmental fees or donations, then it cannot be taken as deduction. Life insurance premium, if you have taken any life insurance policy and paying a premium for it, then it can be claimed as deduction, the policy amount. Now again, if you are paying a home loan, then in that case the principal component of the home loan can be claimed as 80C deduction. However, the house must be completed to claim the home loan deduction, principal deduction. Now there are a couple of other areas in which you can invest. For example, ELSS, that is equity linked savings scheme. In this case, there are certain designated mutual fund units available in which you are making the investment and you are getting the benefit of section 80C deduction, right? However, they have a lock-in period of 3 years attached to it, and since they are essentially equity oriented mutual funds, they has the tax benefit of equity oriented mutual fund attached to it as well. For example, if the gain amount, once they are long term and they are eligible to be sold, in that case you can sell them, and up to the gain of 1 lakh rupees there will not be any taxes. Beyond that, the rate of tax will be 10%. Now over here I want you to be very cautious, because many people think that if I am making the investment in SIP, that automatically means that I am investing in ELSS, which is not the case. ELSS, yes, SIP is the more popular way to invest, but you can make SIP in all the other mutual funds as well. Therefore, before making the SIP investments, make sure you are investing in tax saving mutual funds, right? Be sure to check they are listed as ELSS or tax saver mutual fund in the offer document. Now tax saver FD, again this is a relatively safer option to save the taxes, but it has a lock-in period of 5 years, and any amount of interest that you are gaining from tax saver FD is taxable in your hand. Now other tax saving options are available, called namely Sukanya Samriddhi Yojana, SSY, National Pension Scheme, and National Saving Certificate and Post Office Deposit Scheme. Now Sukanya Samriddhi Yojana is an excellent way to save the money for your girl child for their further education. So you can opt into Sukanya Samriddhi Yojana as early as she is born, and you can contribute up till she attains majority, and you can withdraw the money for her marriage purposes or higher education purposes. Now other investment options are pension scheme, which is normally comes under 80C. You can invest in any annuity plan of LIC or any other insurer for the matter, and you can withdraw the money from pension. You can contribute the money for pension and get the benefit of it. Now, if you are making a contribution towards NPS, then there are three ways you can save the taxes. Number one, normally if you are making the investment in NPS, it goes under 80C limit, right? But if you are not taking the benefit of NPS under 80C, you can get a deduction of that contribution under a different section altogether, that is 80CCD 1B. Now, maximum amount you can claim is 50,000 rupees as deduction from the taxable income. And in NPS, you can also contribute through your employer. They can contribute maximum up to 10% of the salary, that is the basic salary, and your own account, which is used for your own contribution, that can be taken for the contribution purposes as well. Now, there are certain ways you can invest the money and go beyond 80C limit of 1,50,000 rupees. For example, you can invest in health insurance premium, right? In case you are a senior citizen, then 50,000 rupees is the limit for you, your spouse and your children. In case you are not a senior citizen, then maximum 25,000 rupees can be claimed as premium on insurance policy, health insurance policy, right? In case you have dependent parents and they are senior citizen, then 50,000 rupees can be taken as deduction. For dependent parents who are not senior citizen, maximum amount that can be claimed is 25,000 rupees. Now, medical expenses can also be taken in lieu of medical insurance, provided the senior citizens are not covered under any medical insurance. Now, that means they should not be covered under any group insurance policy. They should not be covered under any insurance policy provided by their employer. Now, here I would like to clarify one thing very specifically, that is, sometimes it may so happens for certain procedure, the insurance organization, they do not provide any cover whatsoever. They do not reimburse or they do not provide any monetary benefit. In that case, you cannot claim medical expenses in lieu of medical insurance, because they are still covered under a specific medical insurance. Just because the insurer is not giving money, you cannot claim the medical expenses in the income tax return. Now, there are other sections under which you can claim the deduction. For example, 80DD. Now, 80DD is triggered when a dependent person of the person in question is differently abled. Now, if the disability limit is more than 40%, then a blanket deduction of 75,000 rupees can be claimed. If the disability is severe, that is more than 80%, in that case, a blanket deduction of 1,25,000 rupees can be claimed. Now, if the assessee or dependent of the assessee is diagnosed with specific diseases, for example, motor neuron disease such as Parkinson's and dementia, or any other diseases, for example, AIDS or cancer, those sort of thing, in that case, for medical treatment purposes, 40,000 rupees or 1 lakh rupees, depending on the age of the person concerned, will be given to as deduction. Now, these amounts are maximum amount. If the actual expenditure is lesser than that, then the lesser amount will be allowed as deduction. Now, when the person in question, the assessee himself or herself, is differently abled, then similar deduction like 80DD is extended, but under a different section number, that is section 80U. Now, for this 80U and 80DD purposes, you need to have a certificate from a medical professional, right? In that certificate, the name, age, disability percentage, type of disability, everything should be mentioned. Normally, it is issued by a medical practitioner or it is issued by the municipality. Now, education on interest loan, education loan. Now, if you have taken a education loan for your higher education, in that case, without any limit, the interest can be claimed as deduction. there are certain things you need to remember. Firstly, the loan should be coming from a banking institute. Secondly, the loan is allowed from the year you start repaying the loan, and the maximum amount can be claimed for a period of 8 years, including the year of first payment. Now you can make donation into charitable institute, or you can make donation to any other charitable fund or religious fund, and you can claim a deduction. Now in case you are making the donation in PM relief funds or PM care fund or CM disaster management fund, in those cases 100% of amount, whatever amount you have donated, can be taken as deduction from the taxable income. In case you are making the donation to any other charitable organization, in that case whatever you have donated, of that 50% will be taken as deduction. Now at the beginning of the year, it is very much requirement from you to select number one tax regime and declare investments depending on the regime that you are selecting. If you are selecting new tax regime, then it becomes very less obvious for you, but if you are opting for the old tax regime, then it becomes very much a requirement from your side, because if you are not declaring and you are going with the old tax regime, a very huge amount of tax can be deducted from your income. Now let's try to take a look at the new tax regime, right? Whether new tax regime is available, how beneficial is the new tax regime. New tax regime is beneficial for you if you do not really have any sort of investment. Furthermore, the new tax regime has been made default from this year onwards, right? So if you are not selecting new tax regime on your own, then the new tax regime will be selected for you. If you are not selecting old tax regime actively, the new tax regime will be selected for you. Secondly, under the new tax regime, standard deduction of 50,000 rupees has been extended, right? So previously the standard deduction was only available under the old tax regime. Now you can take the deduction of standard deduction under the new tax regime as well. Now there are slab rates which are mentioned under the new tax regime. So slab rate has been tweaked. Now every incremental income of 3 lakh rupees will result in incremental tax percentage of 5. Right. So if your income is falling within the bracket of 0 to 3 lakh rupees, the rate of tax will be nil. From 3 lakh to 6 lakh rupees, the rate of tax will be 5%. From 6 to 9 lakh rupees, the rate of tax will be 10%, so on and so forth. Now maximum rate is 30%, which is triggered once you cross 50 lakh rupees. Now under the new tax regime, there are again a massive change, wherein if your earning is not crossing 7 lakh rupees, right? If your earning is not crossing 7 lakh rupees under the new tax regime, then you are not supposed to pay any taxes. However, you are required to file your income tax return most definitely, but there will not be any implication of taxes. Furthermore, marginal relief has also been introduced under the new tax regime. That is, if your income is fractionally over 7 lakh rupees, wherein you are not supposed to pay any taxes, in that case, instead of paying the tax on the entire amount, you will be charged a smaller sum, which is normally the amount which is beyond 7 lakh rupees. Now let's try to understand this with an example. If your income is 7,10,000 rupees, by the slab rates given, your tax liability should be 26,000 rupees. However, your income is marginally over 7 lakh rupees, that is only by 10,000 rupees. Just because your income is increasing by 10,000 rupees, you are supposed to pay 26,000 rupees of taxes. Now this does not sound very right. Therefore, what the government does is, instead of collecting the entire 26,000 rupees as taxes from your end, they collect 10,000 rupees, that is the incremental income beyond 7 lakh rupees. In that case, you are done once you pay 10,000 rupees of taxes. However, it must be noted that marginal relief stops at 7,27,777 rupees of earning level. Beyond, if your earning is beyond that, then marginal relief will not be given to you, or it will not make any sense. Now, under the new tax regime, the higher percentage of surcharge rate has been reduced. Now, the maximum surcharge that can be levied under the new tax regime is 25%. Now, let's take a look whether the new tax regime is beneficial for you or not. Now, we have taken a consideration of 16 lakh rupees of income, right? Now, standard deduction is available under the new tax regime after the budget has been made, and old tax regime, right? So it will give me 15 lakh 50,000 rupees under both the regimes. Now, under the old tax regime, I can take deduction of home loan interest, I can take deduction of 8TC, 8TD, NPS contribution by my own, and after taking contribution to NPS from my employer, my total taxable income is coming to 10 lakh 50,000 rupees. However, the interest on home loan, 8TC, 8TD, all those deductions are not available under the new tax regime. However, the employer contribution to NPS is available under the new tax regime after the budget. Therefore, it will be deducted, and my taxable income under the new tax regime will be 15 lakh rupees. Now, based on the income rate, based on the income of 10 lakh 50,000 rupees, my total tax under the old tax regime will come to 1,27,500 rupees, and after including the cess of 5,100 rupees, my total tax payable will be coming to 1,32,600 rupees. Now, if we look at the new slabs and the tax rate prescribed, we will see that for 15 lakh rupees of taxable income, my income tax will be coming to 1,50,000 rupees, and after including 4% of health and education cess, which is 6,000 rupees, my total tax liability would be coming to 1,56,000 rupees. Now, there is a gap of 24,000 rupees between the new tax regime and the old tax regime. Now, we are at the end of our session. Now, if you do have any questions, please let us know so that we can answer them. Right. So thank you all for joining with us. It was a wonderful session. Thank you for your time. Have a great day. Bye.